Hi everyone. We are talking about interest rates today. Typical question which could be confusing. It's to understand the difference between treasury notes or treasury bonds versus yield futures contracts. Uh, let's start with being visual. On the screen right now, I am displaying the chart of the 10-year treasury note futures. This is a product in the CME exchange. And if we compare this product with the symbol ZN1 exclamation mark with the 10-year yield futures, which is a micro contract, so we can see that basically this is a mirror image where one of the contracts is pointing down, whereas the other contract is pointing up. Again, for the ones of you that have studied or read about the pricing of bonds and interest rates, you would probably know that those are prices that move in opposite direction. They are inverse. Okay, this is a great oversimplification, but basically this is a great concept to keep in mind because if I switch to any note or bond, as right now we are looking at a 30-year bond, a 10-year treasury note, 5-year treasury note. As we can see in the latest part of the price movement, the markets were going higher. Whereas if I switch to the 10-year yield futures, it's exactly the same move, but going down. Okay, if we look at 2-year yield futures, same move, going down instead of going up. So in other words, treasuries or bonds and the yield move in the opposite direction. This is something to keep in mind if you didn't know. Now, with this in mind, which of those contracts, maybe the most ideal one for me to trade? How do I know that? How do we find out the answer to such important question for traders and investors? Well, of course, a very healthy action would be to go to the website, in this case of the CME group, look into markets, look at the interest rate group to find what we call the contracts themselves and what we call the contract specifications. If I was to zoom out, so we get full view here, and we click on products, so we get to see all the products available. We can see that actually there are many. I want to point at the US Treasuries, which are the ones I am mentioning in today's video. So I'm going to open that in a different tab. And I'm also pointing at the yield futures, right click, open in a new tab. So I'm going to analyze those two tabs. So on the first tab, what do we have? Well, we have 2-year treasury note, 5-year treasury note, 10-year, all the way to the bond, which is 30 years. Many contracts. On the yield side, if we look at specs here, we're going to have a nice table that tells us that we have the 2-year, the 5-year, the 10-year, and the 30 years. This is the yield, not the note or the bond. It's the yield, it's the inverse, if you wish. So again, how do I know which one should I trade, etc.? So one thing that is very useful is to begin with looking at volumes. So we could load an indicator here called volume, and I'm gonna activate the moving average for this volume indicator in the bottom part of the screen, which shows that the 2-year yield has 112 contracts traded per day. This is a daily time frame. You can see here the 1D for daily. We can look at the 10-year note, and then we are looking at 4,600 contracts as an average. We can look at the 5-year note in this case, and now we are talking about 1.2 million. We can look at the 10-year note, and it's 1.9 million per day, and then the 30-year bond, which is, let's call it 500,000. So, in other words, first of all, we can identify clearly here that both the 10-year treasury note as well as the 10-year yield futures contract are the most liquid. And because we are doing a little bit of a comparison today, I'm going to focus on the 10-year. Okay. And the question is, okay, so, how do I know more about those 10-year contracts now that I know they are possibly the most liquid ones? But again, going back to the CME website, if you click on 10-year, in this case year future yield futures, you will get access to the contract specifications. And here you can find out more about how much is a point. You can find out more about the margins, how much money I need in my account as collateral to be allowed to take the trade. This is the recommendation from the exchange. Of course, your brokers may request a different value than that, but it's a good reference. And if we look at the other tab I had with the notes, so we can look at the 10-year treasury note, which is the one we are looking at. And we're going to do the same thing. We're going to click on contract specifications first, where you can go ahead and read, how much is a point, how much is a tick, even though here you can see a very interesting characteristic of notes and bonds, which they trade in half a point, in 1/32 of a point, quarters of a point if you're doing calendar spreads. So again, it gets a bit more complex, even though it doesn't need to be, as you will see in a moment. Also, of course, margins in this case, since the size of this contract is larger, the margin is going to be more. Instead of $300, it's $2,000. Okay. So being pragmatic, which one may be the right candidate for you to trade? How should you expose yourself to these markets? And there are millions on way on how to trade. In this case, my trading style is UFO trading. So I'm just gonna look and analyze the markets here and draw UFOs where I understand a turning point may happen. So when price comes in here, the expectation would be the 10-year yield futures contracts would fall. So I will want to short at this price point. We'll talk about this in a moment. And if instead of looking at the yield contract, I was using the treasury note, the 10-year treasury note, so I would do the same analysis. Of course, it's going to be upside down now because my UFO entry area would be here. So I would expect price to come here and from there have a bounce. So here I would want to go long around those prices. Again, for sure, some of you watching this may be breakout traders, may trade chart patterns. We have different trading styles. This is really not the point of today's video. The point of the video really is to understand more about the characteristics of the product, so you know which one may be more adequate for you, given your account size, your risk profile, etc., etc. So let's pretend we are planning on a trade to trade the 10-year bond, and because my UFO here is lining up with this candle, I'm just going to try to be a bit more visual. Let me go ahead and delete this. So basically, I'm going to define a trading range from the top of this candle all the way to the bottom part of that candle right here. Okay, and that range is the trading range, meaning that the upper part of the range, the upper part of the candle, it's going to be my entry, and the bottom part is going to be my stop. Notice how the entry price, which is the high of this candle, is 109,085. Now, again, the way treasury notes and bonds are priced, as you can see on the price scale, is very much different compared to almost any other market out there, which normally you have a number which may have decimal places, but definitely you don't have this very original way on how to be priced. This is very characteristic of bonds. Now, while the pricing is different, and we could actually run a different video to talk about that more in detail, what I'm going to do here is to be very pragmatic. I'm just going to put my mouse on the top of this candle. The top of this candle is 109,085. So I'm just putting my mouse right there, and I'm just going to right click, and TradingView gives me the option to copy the price 109,085. So I don't have to type this funny number. If you are new to trading treasuries, if you are not new, of course you are used to this, but if you are new, it may feel like a funny number. So I want to go long the 10-year treasury note futures contract at 109,085. Sorry, 109,085. Let's say I place a stop using the bottom part of this candle, and the bottom part of this candle is going to be the low, which the low is 109,005. So I'm just going to do the same thing, just try to be pragmatic here, move my mouse to the bottom part of the candle, right click, copy the price, so I don't have to type, and I avoid mistakes, especially if you are new to this type of decimal nomenclature or syntax, I should say. And then I'm going to paste it where the stop would go. And by doing that, now I have specified that the distance between entry to stop is actually 25 ticks. Okay, 25 ticks, knowing that a tick, going back to contract specifications, a tick is 1/30, a half of 1/32 of a point, which is 1 divided by 64, if you wish. That's another way to think about it. So, but again, not to get complicated with fractions and all of that, I just right-clicked and copy from the screen, and now, TradingView does the math for you. Thank you very much. 25 ticks, and therefore this trade, if I was to use one contract at a time, would be risking $390 per contract if I was to get executed at this price point, and instead of having the market move up as expected based on my trading plan, if instead I was to have this market fall and stop me out, I will now collect a loss without slippage. Of course, I may get some slippage. I would collect a loss of $390. Okay, rounding numbers. Okay, what if I did the same thing with the 10-year yield? Okay, well, we're gonna see different differences. First of all, the price scale, it's normal numbers that actually represent the current interest rate, 4.394%. That's actually the representation of the interest rate. So very easy to read, very easy to interpret. If you are new to trading treasuries, probably you would feel this is more friendly to you. Okay, we have our entry point with that UFO right here. Well, in this case, I'm going to do the same thing I did earlier. I'm just going to focus on this candle, okay, where this is going to be my top for the stop, and the bottom part is going to be the entry. In this case, we're going to be planning on a short trade instead of long. So we expect that when price comes here, we will short. Expectation is the price drops and the stop will go right above. So if it goes up, right here is going to be our exit for a loss through a stop loss order. So let's pretend we did that, and this will really help us to understand the difference between the 10-year Treasury note futures as compared with the 10-year yield futures contracts, which is kind of the same, but at the same time, very much different from a trading product. And here you will see right now. So I'm going to do the same thing. I'm going to put my mouse where the low price is, which is 43.6. Right click, copy 4.436, even though that is easier to type, so I could certainly also choose to type it. Here we go. And then my stop will be the top of this candle. So the top of that candle is going to be the high, 4.476. So 4.476 right there. So right click, 4.476, and I'm going to add this number to my stop loss. So when I do that, notice how I am 40 ticks away, even though it's in a way is the same distance, because this is the same market, just is inverted, because it's the yield instead of the note. But in a very pragmatic and realistic manner, you can see here the tick distance to the stop, which will be 40, and the risk per contract. Notice that those yield contracts are micro size. So of course, my size is much less, and therefore, instead of risking $390 per contract, the risk here is $40 per contract, which makes it ideal for a trader who wants to have more of an option to do scaling in or scaling out type of techniques, or just maybe a trader with a smaller account size that needs to trade a smaller size. Okay, very good. So hopefully this video has been useful to understand the characteristics of these products, how they compare. Being the same thing, they are not the same thing. Again, hopefully this was useful to you, and looking forward to seeing you in the next one. Thanks so much. Bye-bye.